U.S. stocks are retreating from record highs following an inflation report that remains above the Fed's 2% target. Though despite today's losses, the S&P 500 posting its fourth straight monthly advance with expectations intact that the Fed will cut rates twice this year. For more on that, we bring in Jim Bianco, president at Bianco Research, right now joining us. Jim, we saw inflation report coming in hotter than expected, though we did see the consumer hanging in there. What are you expecting as we head into a critical jobs report next week, as well as a closely watched Fed decision next month?
Well, I think the Fed has pretty much communicated that they're going to cut rates at the September meeting for the first time in about 10 months. Now, that I've said that, I would also say I think that this is a soft number. What I mean by that is if next week's payroll report or the September 11th CPI numbers are more than expected, that could basically push this probability back to 50-50. So I don't think the final chapter is written on this rate cut for September, but it's pretty likely that we're going to see one.
What kind of fallout would we see in the market across assets if we do get economic data that makes this, to your point, more of a coin flip than a locked-in decision?
I actually think it would be supportive for the bond market. I'm one that looks at what happened last year because the Fed at the same September meeting a year ago, after Jay Powell went to Jackson Hole and said that there was problems with the labor market, we have to cut rates, just like he did last week, they cut rates and long-term interest rates rejected it by going up in yield. And I think that that's the risk we have now. The 30-year yield is actually higher right now than it was 1 minute before the payroll report on August 1st. So all this talk about the Fed's going to cut rates, saying that they're going to cut rates, the weak payroll report, it's not moving long-term yields down. And I think the risk you face is that they're going to go up if the Fed cuts rates and what they perceive as the weakness in the economy does not come to pass. So if they actually threw that into doubt, it might be supportive for the bond market.
So you mentioned the 30-year yield. I'm looking at it right now, 4.92%. And, you know, it's kind of been stuck in a range over the past 3 months. It hasn't gotten to that 5% level we saw in mid-July, which, of course, is the highest going back to, I think, something like, you know, a couple of months, if not longer than that. What breaks us out of that range? I mean, yields can go up, but are they going to get past 5% again?
Well, I think it's going to be one of two things. It's either going to be signs that the economy is really slowing down. We don't really have that right now. If you look at the Atlanta Fed GDP number, it was revised up big today, suggesting that the third quarter is looking like 3.5% growth. Or it's going to be signs that the economy's heating up and that inflation is starting to percolate as well. Remember now, we have core inflation at PCE at 2.9. We have core inflation at CPI at 3.1. I'm old enough to remember a couple of years ago, these would have been completely unacceptable numbers from the Fed. But now they're going to cut rates in the face of those numbers. So if they keep going up, that could actually push yields much higher if the market feels like the Fed's making a mistake again. So it depends on what we get, because right now we're kind of stuck in this range and it's the end of the summer and nobody really cares. But eventually when they're coming back after Labor Day in 3 days, and maybe they'll start carrying again.
Yeah, well, we'll keep an eye on that one. I'm curious how you think the drama over what's taking place at the Fed, between the president and the Fed as an institution, how that's going to weigh on policymakers as they deliberate over what to do in September and how they set themselves up for the rest of the year into 2026.
I think it's going to weigh a lot on them, and I think it is mattering a lot for the institution. It is going to be highly disruptive, whatever happens with the court ruling with Lisa Cook next week. Either way, either she gets an injunction, she gets to stay, or she doesn't get an injunction and she has to fight this as a non-Fed employee. And I think that we're starting to see that show up with the way that Jay Powell has been reacting to the market and everybody else. I think this is going to have long-term implications for the Fed. I know everybody likes to say it's going to be loss of independence. It doesn't necessarily have to be that. But I do think that the more immediate impact is going to be the role of dissents. The Fed never has any dissents in their voting. I've been one that's argued that this is the biggest weakness that the Fed has, is this group that everybody has to agree with everybody else. And if this breaks them of this could be actually a long-term good for the Fed, in addition to all the other risks that they face.
All right, Jim, really appreciate it. Jim Bianco, president at Bianco Research. And a lot of people say maybe it should be more like the Bank of England, where there is a lot of dissension, and it's okay.
It's interesting.
This is The Close on Bloomberg.